All right. So this is a podcast that's good for everybody, really, but it's specific to my business owner clients, and uh, the reason is because business owners, what I found is that when they walk in my door, I'm not usually the first advisor that they've met, and generally speaking, what they're looking for is, well, they don't know what they're looking for. They're looking for advice and help. Taxes is a big problem almost always. And also exiting their business is a big issue. Even if they haven't considered it, when I bring it up, hey, there's an exit that will happen eventually. You'll either sell this business to an insider, maybe an employee or a family member, or maybe you'll sell to an outsider, a friendly competitor, or you're going to die with it. You're going to exit the business. Um, and so what I see is a lot of fancy planning. And it's not that the planning is incorrect. It's just that, boy, does it really, it doesn't always provide flexibility. And in my experience, I mean, as a business owner myself, I value flexibility over everything else. And this is just me. I mean, it doesn't mean that you have to agree with it, but I would rather pay more taxes if it means I have more flexibility, if I can pull different levers at different times. There's an advantage to that, and I'm going to use a popular TV show, Landman. Hopefully, you've seen it. If not, maybe go watch it. It's good. It's one of those Yellowstone type shows, and it deals with oil men in Texas, and it's a cool story. It's good stories, and we're in season 2. And episode 5 in season 2 caught my eye. I'm watching the show, and my wife's sitting there, and what happened, spoiler alert. So if you haven't seen the show, don't listen to the rest of this podcast, but there was a death of a business owner. His wife takes over the business. So Monty has passed away. This happened in season 1. So I'm really not giving away too much here. And his wife, Cammie, takes over the business. It's an oil business. And, there's a transfer of ownership. Now that's an insider sale. We'll say it's a transfer of ownership, but it doesn't seem like there was a lot of thought process behind it, because what's happening is I'm watching the show on the couch, and basically what's going on is they're trying to find a big sum of money that nobody could figure out where it went. And it was a $400 million amount of money. So the man who's actually effectively running the company is Billy Bob Thornton's character. Cammie is Demi Moore's character. The wife, she owns the company now, and they're meeting with a few attorneys and then the financial advisor of the now deceased business owner, Monty. And they're saying, hey, where's the money? Where's this 400 million? And I kind of thought they were going to, take it in the direction of fraud, but it wasn't that. It wasn't that the advisor hid the money or lost the money or anything like that. What he had set up was something called a captive insurance company. And I'm not going to speak to that really in any detail on this podcast, but it's essentially something you can set up that will help, avoid income taxes in a very legal way. I mean, it's a I wouldn't call it routine, but it's something that, very high income business owners will look at as something that they might look at, they might do. And so they start talking about this, and I've never heard of that phrase or that, being used on a TV show. Very few people would know what this guy was talking about, the financial advisor. And that wasn't the problem. Okay. So he was basically walking them through, okay, this is where the $400 million went. It went into this other entity. And the other entity was basically set up as like an insurance company, and it owned, I'm going to assume, the jets and the things like that inside the company. And so I'm just going to assume that was set up the correct way. That wasn't the problem. The problem was when the business owner died, Monty, the man who owned and ran the business, when he died and they didn't have liquidity, the wife who's now owning the company and the man who is now running the company for and with her needed access to capital. They needed liquidity. They needed the 400 million. When the advisor sat down and they said, okay, great, now we know where the 400 million is, this is the part that caught my attention. He said, well, yeah, we have it, but we invested it into private equity. And so it's not very liquid. And that's probably a polite way of putting it. Private equity is something that is out there. My young clients are asking about things like private equity and private credit. What is it? Well, think about public equity for a second. So any stock that you can think of, Apple and Meta and Tesla and Exxon and Caterpillar and Harley Davidson, whatever the companies are, that's public. Anybody can go buy it. Anybody can go sell it. Instant liquidity. I mean, you can sell your stocks and buy your stocks on your phone. That's public. Private equity is the opposite. Private equity would be companies that aren't available. Either they're not available yet for purchase. Think like Elon Musk's, some of his companies, the Boring Company or SpaceX, something like that. We can't just go buy shares of that company. Because it's a private company, now you might be able to buy private shares. And so there are funds out there that invest clients' money and people's money in things like private equity, private credit, not publicly traded. It's fancy. There's the supposition that you're going to get a higher return, whether you do or not honestly, it's kind of hard to tell because again, it's not public information. And so you have to kind of go with the information that they give you. But here's the real problem. This is what happened on Landman. You have a situation where there's now a change of ownership. And because for whatever reason, the man who passed away had it inside of his C Corp, and then the C Corp took it and invested it into private equity. Now the wife, Cammie, who needs liquidity, she really can't sell that money. I mean, she can, but she's not going to sell it dollar for dollar. It's not a liquid market. And even on the show, I think the advisor said something like you'll get 40 cents on the dollar or something like that. And who knows what it really is. It's very difficult because you got to find buyers who are willing to buy it. And they know that you're going to sell it at a loss, essentially, for less than what it is. Now, why are we talking about this in a podcast for my business owner clients? Really, it's kind of a warning. What I found is that you are successful in your business because you're amazing at it. Like, you know it intimately. You've done it for a long time. You're better at it than your competitors, let's say. You've built something with your own sweat equity. And generally speaking, you've built it with flexibility because you know there's rainy days. You know there's good times and there's bad times, and you know how to operate your business. Then you get past survival mode. The early years of running a business, you get past survival mode, and now you start looking at it and you go, hey, I've got the means to do some real planning here. And advisors come in and they start doing what I call, they get fancy. Rather than being flexible and liquid and positioning your money in situations where if you need it, you can get your hands on it, they start using things that maybe their competitors are showing. Things like private equity and private credit. My advice would be, look, I don't know who's listening to the podcast. I don't know the situation that they're in, but I would start with simple. Always start with simple. Keep things flexible. Address issues maybe without the most new and shiny product out there. You don't need that. Your business is the shiny product. The rest of it is your financial plan, and that's really there to help facilitate what that business is providing to you and your family now and in the future. Now, look, Monty and the TV show Landman, the guy, I'm presuming he's worth $1 billion or so or more. And so the answers for him are not the answers for everybody, but I would submit that you need to look at things like life insurance. If you're a business owner and something happens to you and there's not an easy transition of sale to maybe somebody in the family or your spouse or an outsider, you need liquidity. Your family needs liquidity. Even if you've got money invested in regular public equities, savings accounts and whatnot, you need an influx of liquidity. And things like life insurance do that. It's not very sexy. It's not new. It's been around forever. You know why? Because it works. And so my message really for the business owner clients is that run your business and take the risk and do the things that you know and that you're amazing at and you've built your empire on. And then the rest of it, the financial plan that's there to support that, don't take crazy risks there. Don't buy new and fancy. Don't go for the shiny object. Go for simplicity and flexibility and certainty. That would be my advice on the business owners. And I just thought that this recent Landman episode was maybe it's the nerd in me, but I thought it was really cool because I'm sitting there and something popped out to me that I see in real life. I've never seen addressed on a TV show. And so I thought it would be fun to kind of comment on that. We'll see you in a couple weeks.
Joe DeLisi is a registered representative and financial advisor of Park Avenue Securities, LLC, OSJ 5280 Carroll Canyon Road, 300 San Diego, California, 92121 619 648 Securities products and advisory services offered through PAS, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of PAS or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC. CA Insurance License number 0D34103. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Guardian and its subsidiaries do not issue or advise with regard to mortgages, property and casualty insurance, and/or car insurance. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. Investing in securities of smaller companies tends to be more volatile and less liquid than securities of larger companies. Investing in the bond market is subject to certain risks, including market, interest rate, issuer, credit, and inflation risk. This material is intended for general use. By providing this content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation, or to otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged and one cannot invest directly in an index. A6924441 expires January 2028.